And if you look at the economic data continues to beat. So we had New York manufacturing was supposed to come in negative 27%, came in about flat. Retail sales, as we talked about, plus 18%. Building permits missed expectations, but they're still up 15% month on month. Starts are up 4.2%. So we're seeing it across the board. What was extreme pessimism is now showing in the numbers that it's better than anticipated, and expectations are very low. One of the things that I look at each month very carefully, Melody, is the Bank of America Global Fund Manager Survey. This survey is about 200 managers that manage $500 billion of assets under management. And 53% are still saying, after a 45% rally, they're still saying this is a bear market rally. Only 18% expect that this is going to be a V-shaped recovery. 46% still expect a prolonged recession. Now that's down from 93% last month, so that fear and pessimism is thawing as we see more and more data that beats expectations. And 78% believe that the market's overvalued. That's the highest level since 1998. And if you remember, we still rallied for another year and a half to 2 years in a material way. So that's the outlook. Is very, very pessimistic, Melody, but the positioning is starting to change. Managers are being forced in against their will here. We saw in the last 30 days the biggest drop in cash since August of 2009. So if you remember, from March to August 2009, the market rallied 50% off the lows. And many people felt that they missed the rally and it was going to go back down and take out the lows. It's a similar situation now, having rallied 45% off the lows. People feel like they missed it, but I'll bet everyone on this show wouldn't mind having bought in August of 2009.
Yeah, so, it's a risk-reward balancing act, of course. One quick follow-up on Powell's statement. There was one interesting qualifier that he made during today's testimony. He said that the Fed isn't considering negative interest rates, quote unquote, at this time, which is actually a new kind of phrase that we've heard from him. Can we anticipate negative rates? We know that Powell and co have promised near zero interest rates until at least 2022.
Yeah, it's funny that you bring that up. So Powell has explicitly said in the past, we will not see negative rates because that's the surest way to destroy banks. Okay, so they saw what happened in Europe over the last decade and how those banks have not been extending credit and holding back the expansion and holding back the recovery because of the situation. So Powell will increase asset purchases if necessary. They'll do yield curve control. They have a number of tools in their box. Negative interest rates will not be one because that's the surest way to destroy banks and cut off credit, which is essential for the recovery in the economy. And actually, it's funny that you bring up rates because in the last 2 months, the yield curve has steepened the fastest that it's done so since 2009 and 2003. And those years preceded multi-year rallies in banks and financials. So, for people who feel like they missed the rally, there are still certain sectors and subsectors that had lagged behind that historically coming out of recessions tend to have the best relative performance for the early part of the cycle coming out of a recession. And banks certainly fit that mold. And we've seen it in the yield curve in the last 2 months, mimicking 2009 and 2003.
Tom, when you think about the cohorts that have been most deeply affected by the coronavirus pandemic, they are people who are people of color, women for the most part. And Powell had some interesting words to say about the kind of uneven impact the coronavirus pandemic has had.
Low-income households have experienced by far the sharpest drop in employment, while job losses of African Americans, Hispanics, and women have been greater than those of other groups. If not contained and reversed, the downturn could further widen gaps in economic well-being that the long expansion had made some progress in closing.
Best times for our economy to perhaps one of the worst. How do you interpret this sort of messaging and the data, the hard data that shows that the communities that have been disproportionately affected will perhaps continue to bear the brunt of this economic recovery?
Yeah, well, Melody, that's a great point. And the reason that these groups have been disproportionately affected is unfortunately they're disproportionately in those sectors that happen to be hit by what is being referred to as a natural disaster, in the front-facing jobs like leisure, like restaurants, like travel, et cetera. So that's unfortunate. If you look at the data pre-pandemic, though, these cohorts of minorities and these type of groups, they had the lowest unemployment rate in recorded data history. So, basically we had a natural disaster come in, it disproportionately hit a sector where their employment was concentrated. And Powell has said repeatedly, he's going to focus on doing as much stimulus as possible to make sure that groups that got hit by this are not going to be left behind. Like the great financial crisis, it took many, many years for the people that got hit to recover. And it's his commitment that he brings those jobs back as fast as possible. And so far, he's put his money where his mouth is and really done everything under the sun to get this recovery back much sooner than anticipated.
Thanks so much for talking to us today. Thomas Hayes, Great Hill Capital Chairman. We'll speak to you soon.
Thank you, Melody.